Spot isn't telling you the whole story right now. Physical is, and the paper market is trying to pretend it's still in control. Silver has already screamed higher this month, jumping from the low 70s per ounce at the start of January to above $100 by January 23rd. And that kind of move usually convinces people the easy part is done. But here is the twist that most people miss. The real stress doesn't just start when the chart looks bullish. It starts when the screen price pauses and the real world price keeps climbing anyway. Because that's not just a vibe, that's a spread. And spreads are where markets confess. On your chart, silver can look like one clean instrument. Last traded price, a candle, a line, a neat little story. On the street, at dealers, at wholesalers, and procurement, in the back end of supply chains, silver behaves like a different commodity entirely. Same element, different rules, different deadlines, different penalties for being late. And if you want to understand why premiums are rising while spot lags, you have to stop thinking of premiums as a retail tax. They're not just markups. They are the market posting a surcharge for immediacy. A time and delivery spread in disguise. And when that surcharge rises, it tells you something the headline price is too slow to admit. Somebody needs metal now, not metal later, and the system is charging them for the privilege. And that's where the real pressure starts. Let's ground this in what right now actually means, because timing is everything in this trade. We're sitting in late January 2026, and silver has just put in one of those moves that rearranges portfolios. You've done a T-drift from the low 70s to triple digits in a few weeks without breaking someone's risk model. That's not a normal grind. That's a liquidity event. It's the kind of rally that forces participants to make decisions under stress. Dealers widen spreads, shorts feel margin creep options. Dealers start hedging more aggressively, and physical buyers done to get the luxury of waiting for a dip if they refilling orders or feeding a production line. And when price moves that fast, the market doesn't stay unified. It fractures. Paper can trade one thing while physical trades another. And that fracture is exactly what you're seeing when premiums rise while spot pauses or backfills. But that's not the part that matters most. The part that matters is the mechanism underneath it, because the mechanism tells you what happens next week, not just what happened last week. Futures markets are extraordinary at broadcasting a single number, but they are not built to guarantee you a specific bar in a specific location on a specific day. A futures price is a financial clearing price for exposure. Physical is a supply chain. They rhyme, but they're not identical. Physical metal has form factors, freight constraints, insurance, financing, refinery lead times, and the brutally simple fact that an ounce in the wrong place at the wrong time might as well be an ounce on the moon. So when physical premiums climb, that often means the bottleneck isn't silver exists. i.e., the bottleneck is deliverable silver exists where it's needed, in the form it's needed, on the timeline the buyer needs. And if you keep that frame, the whole story snaps into focus. Here is the hidden detail that reframes everything. A premium is the market, S way of pricing the inconvenience and risk of waiting. It's not just extra profit. It's a posted price for immediacy and certainty. If you're a retail buyer, you experience it as, why are coins so expensive when spot is lower? If you're an industrial buyer, you experience it as, why is the quote only valid for a few hours? And why did lead time just extend? If you're a wholesaler, you experience it as, why did my replacement cost just jump even though the screen didn't word a T? Like same signal, different language. And that's why premiums rising while spot lags is not a cute anomaly. It aims as a warning light that the physical market is tightening faster than the paper market is repricing. And the next detail is what flips the whole setup. Because if the physical market is pulling away, arbitrage should, in theory, drag them back together. That's the textbook. If physical is expensive, sell physical, buy futures, deliver, profit. Clean, elegant. But that's not how it works in a stress window. Arbitrage is not a magic wand. It's a chain of steps, and every step has friction. You need inventory that meets specs. You need it in the right jurisdiction. You need financing. You need operational capacity. You need someone willing to part with metal, not just hold it. And in a market where people are buying for protection, against inflation expectations, against currency stress, against policy uncertainty, against geopolitical risk, willing to part with metal becomes a very expensive sentence. So the spread can persist longer than people think, long enough to force behavior. And forced behavior is what moves price. This is where market structure becomes your best friend, because it lets you see pressure before it shows up on the headline ticker. Instead of obsessing over spot, watch how the market prices time, watch the curve, watch the nearby versus the deferred, watch the spreads. Because when a market is genuinely flush, it usually prices carry. Storage, financing, time, that's contango logic. Later months slightly higher to reflect the cost of holding. But when a market is tight on immediacy, it can invert. Nearby strength shows up. Backwardation shows up. or at least a dramatic flattening. And when the curve starts acting like it's scared of the front month, that's not a technical pattern. That's a supply chain message. Now, I'm not here to claim some cartoon villain is suppressing silver with a secret lever. Markets don't need a conspiracy to do something that looks like a contradiction. Incentives and constraints are enough. Futures markets are deep, liquid, and heavily used by hedgers, funds, and dealers. Physical markets are segmented and sometimes thin, especially in specific products, certain bar sizes, minted coins, small lot retail distribution. So you can absolutely see a world where spot stalls because futures liquidity absorbs flow, while physical premiums rise because real-world inventory in the hands that actually sell is getting drained or rationed. And if you've ever watched any commodity under stress, diesel during a refinery outage, shipping containers during a demand spike, microchips in a supply crunch, you know the pattern. The most valuable thing becomes certainty, not the theoretical index price. Silver is no different. It just hides it behind a shiny surface. Let's talk inventories, because this is where people get misled fast. You'll hear, there's plenty of silver in vaults, and someone will point to big published totals. And yes, there's a lot of silver in the world, but inventory isn't a single bucket. Inventory has categories. Some metal is deliverable against futures. Some is eligible but not registered. Some is owned by parties with no intention of delivering. Some is sitting in London vaults as institutional custody, allocated metal that's basically parked. And you can have huge totals while the deliverable float is tight. That's not a conspiracy. It's just ownership and incentives. If I own a bar and I'm holding it as a strategic asset, my bar is inventory on paper, but it is not liquidity to the market. And that distinction becomes everything when demand spikes. London is a perfect example. The London bullion market has monthly vault data, and by the end of December 2025, London vaults held on the order of tens of thousands of tons of silver, with the published figure around 27,818 tons at that time. That sounds enormous, and it is. But here was the question that actually matters. What portion of that pile is willing to be mobilized at the margins to meet new demand? Custody is not the same as flow. A vault can be full and still illiquid if owners won't lease, sell, or swap at reasonable terms. And when flow tightens, you don't always see it first in the headline tons number. You see it in the cost of borrowing metal. You see it in lease dynamics, you see it in spreads, you see it in the way quotes shorten and replacement costs jump. Because if the system is tight, the first thing that moves is the price of time, not the price of the metal itself. But that's not the part that matters most. The part that matters most is what tightness forces the major players to do. When borrowing metal becomes expensive, you're watching a wholesale panic meter. It's quiet, but it's brutal. Bullion banks, market makers, refiners, and large users all rely on the ability to source metal through swaps, leases, and forward structures. If that plumbing gets strained, they don't issue press releases. They widen spreads, they change terms, they shorten quote windows, they demand more collateral, they reduce size, they push buyers into later delivery, they raise premiums. And that transmits down the chain until the retail buyer sees it as coins are suddenly way above spot. So the physical paper split isn't paper is fake. Paper is the clearing layer. Physical is the settlement layer. When settlement capacity tightens, because logistics, refinery output, financing, or ownership preference makes near-term metal scarce, the clearing layer can lag. And when it lags, you get exactly this. Premiums rising while spot seems to hesitate. That split can persist. And if it persists, it eventually forces the paper market to reconcile. Either spot catches up or physical loosens. There aren't many other exits, and that's where the next week or two gets interesting. Now let's add the macro layer, because silver is not a pure precious metal and not a pure industrial metal. It's both. It's a hard asset and a manufacturing input. That dual identity is why it can whip around violently even when the big picture is bullish. In a macro regime where inflation expectations are sticky, rates are volatile, and investors distrust the durability of policy promises, metals attract flows as a hedge. At the same time, industrial demand, particularly from electrification, solar, and broader electronics, creates a baseline of real use that doesn't care about your chart patterns. When those two demand streams align, price can trend. When they diverge, you get whipsaws. And if you're not prepared for that emotionally, the market will use it against you. Here's what I mean. In a fast rally like this month's, where silver pushes into triple digits, two things happen simultaneously. First, momentum funds and macro traders notice the move and pile in. Second, risk managers notice the move and tighten. That's the conflict. Inflows chase, margin requirements rise, volatility climbs, and liquidity thins at exactly the moment everyone thinks they want to trade size. That sets up the classic volatility trap. The market rips, pulls back sharply, shakes out late buyers, then either retests and continues or snaps and unwinds. And you can't survive that with vibes. You survive it with triggers. So let us build the proof stack the way a skeptic would demand it. Not one argument, but layers that point in the same direction. Layer 1, the move itself. Silver didn't drift, it jumped. That's a regime change in behavior, which often means positioning is being forced, not just expressed. Layer 2, the physical symptoms. Premiums rising, availability tightening, quote, window shrinking. That's not a chart opinion. It's a replacement cost reality. Layer 3, term structure. If nearby pricing is firm relative to deferred, the market is pricing immediacy. Layer 4, inventory categorization. Big totals can mask a tight deliverable float. Layer 5, institutional flow. ETFs and large vehicles can lock metal quickly when inflows accelerate. Layer 6, global arbitrage constraints. If metal is there, but not here, the spread persists until logistics and financing bridge it. Each layer alone is arguable. Together, they're pressure. And pressure is what markets respond to. Because markets don't move on narratives, they move on constraints. They move on what participants are forced to do. This is where options and dealer behavior can quietly turbocharge the move. You don't need to believe in a permanent squeeze to understand gamma reflexivity. When price climbs fast, call options go in the money, delta rises, and dealers who sold those calls often hedge by buying the underlying or buying futures. That hedging demand can create a feedback loop, price up, hedging demand up, price up again, especially when liquidity is thin. It doesn't last forever, and it doesn't mean price can't pull back. But it can explain why rallies accelerate in bursts and why pullbacks can be violent when hedges unwind. And in a market like silver, where the float that actually trades can be thinner than people assume, those bursts can be dramatic. And that's where the real pressure starts. Now we need the calendar, because why now is not just a story, it's a schedule. Commodities live on calendars, option expiries, futures expiries, delivery windows, month-end positioning, quarter-end reporting, year-end portfolio rebalancing, and the constant rhythm of financing and roll decisions. Late January is not a neutral time. Funds have New Year mandates, risk budgets reset, month-end approaches, and portfolios get marked. If silver has just exploded higher, risk managers are asking, do we rebalance? Do we hedge? Do we reduce? Dealers are asking, what's my exposure into expiry? What's my hedge ratio? Physical buyers are asking, do we lock supply now before terms worsen? That calendar pressure can compress decisions into days. It can turn a slow story into a fast one. And if you understand that, you stop getting surprised by sudden moves that come out of nowhere. They come out of the calendar. But that's not the part that matters most. The part that matters most is how the physical paper split interacts with that calendar. If physical premiums are rising while spot hesitates, that can mean the physical market is front-running a tighter settlement window. It can mean that the people who must have metal, because they can settle an industrial contract with a chart, are bidding up certainty while paper traders argue about technical levels. And when the deadline hits, when delivery decisions are made, when options roll, when funds must show their hand, the paper market can snap to the physical reality. Not always, but often enough that ignoring the split is a mistake. So what does this mean for you, watching this right now with attention fragile and the tape moving fast? It means you need a two-scenario lens because credibility lives there. Scenario 1, controlled pullback and retest. Price cools, premiums stay firm, spreads stay supported, and the market digests the move without breaking the physical signal. This is the healthy version. Volatility, yes, but structure holds. Scenario 2, continuation squeeze and gap risk. Price rips again, liquidity thins further, shorts cover, dealers hedge, and the market overshoots because participants are forced into the same trade at the same time. This is the violent version, the kind of move that feels irrational until you realize it as mechanical. And the key is that both scenarios can happen in the same month. A pullback doesn't invalidate the thesis, it often tests it. But if one level breaks, the math changes. That's the line you need. Now, I'm not going to pretend I can hand you a guaranteed target like a prophecy, because that's not finance, that's theater. What I can do is give you a framework, what confirms the split, what weakens it, and what would invalidate it. Confirmation looks like this. Physical premiums remain elevated even on pullbacks. Nearby spreads stay firm. Delivery terms stay tight. Quote, windows remain short. ETF flows, if positive, continue to absorb available bars, and the market refuses to normalize quickly. Weakening looks like this. Premiums collapse suddenly without a matching drop in spot, indicating supply caught up or demand cooled. Spreads soften materially, indicating the market is comfortable with time again, and dealers start advertising availability instead of rationing. Invalidation is not price goes down for a day. Invalidation is the physical signal breaking. premiums and spreads relaxing in a sustained way, while inventories mobilize and replacement costs fall. That's when the split closes by physical loosening rather than spot catching up. And here's the uncomfortable truth. The market will try to manipulate you emotionally even if no one is manipulating price. Volatility is the weapon. You'll get a big red candle and a flood of confident voices telling you it's over. Then you'll get a big green candle and a new wave telling you it's the beginning of the end of the dollar. The swing is the point. The swing is designed by structure, by liquidity, by the way people react, to shake out anyone who doesn't have a plan. So your psychological shield is simple. Separate trend signal from noise. Trend signal is persistent physical tightness, persistent strength in time pricing, persistent unwillingness of the market to offer easy metal. Noise is intraday drama, headline ping pong, and the emotional urge to do something because the candle is loud. If you can't distinguish those, you'll keep buying tops and selling bottoms, even with the right thesis. Let's get more concrete about what physical versus paper really means in practice, because this is where people either build trust or lose it. The paper price is a clearing price for standardized contracts. It's extremely efficient at expressing sentiment, hedging, and macro flow. Physical is a settlement reality with specificity. A 1,000-ounce bar is not a 1-ounce coin. A wholesale bar in London is not a retail product in the US. A bar sitting in a vault under one owner, S control, is not the same as a bar available for delivery. When retail demand spikes, it hits mint capacity, distribution, and fabrication. That can raise premiums even if wholesale bars exist. When industrial demand spikes, it hits procurement cycles and long-term contracts. That can tighten near-term availability even if long-term supply is fine. When financial demand spikes, it hits ETF creation baskets and vault flows. That can lock up bars that otherwise might have circulated. And when all three pressures align, even partially, you get a premium environment that feels wrong to people who only stare at spot. But it's not wrong, it's segmented. Now, there's another layer people miss, and it's subtle but powerful. Silver is not just priced in dollars. It's priced in financing conditions. When rates are volatile, when collateral becomes more valuable, when balance sheets get constrained, the willingness to carry inventory changes. Dealers don't want to warehouse risk for free. If financing is expensive or uncertain, they pass it on. That can show up as higher premiums, wider bid-ask spreads, and more conservative inventory management. It can also show up as a stronger front end of the curve, because the market is paying more to secure metal now rather than finance it over time. This is why, in real commodity markets, the curve often tells the truth before the headline price does. The curve is where the cost of scarcity shows up first. And that's the detail that flips the whole setup. So what's the paper market doing while this happens? It's absorbing flow, and it's also reacting to positioning stress. In a move like this month's, shorts don't just lose money. They face margin, they face volatility adjustments, they face risk limits. And when those limits are hit, it doesn't matter if they believe in the thesis or not. They have to reduce. That reduction can be buying. And forced buying is different from voluntary buying. Voluntary buying is patient. Forced buying is urgent. Forced buying doesn't wait for your perfect entry. It pays up. It chases. And in a market where liquidity is already thinning because price is high and spreads widen, forced buying can move price more than people expect. That was why the most explosive moves often happen after the obvious narrative has already been widely discussed, because the narrative isn't the driver. The forced behavior is. But that's not the part that matters most. The part that matters most is what you should watch next, because that's how you turn this into an actionable roadmap instead of a campfire story. Over the next 7 to 14 days, your checklist is short and sharp. First, premiums. Not one screenshot from one dealer, but the direction. Are premiums staying sticky even on dips? That's a tightness tell. Second, time pricing. Watch the near months versus deferred. Are spreads staying firm? Is the market paying for immediacy? Third, any signs of inventory mobilization. Not inventory exists, but inventory is moving into deliverable channels because movement is what matters. Fourth, ETF flow behavior. If inflows accelerate during pullbacks, that can add a structural bid. Fifth, the tone of availability. Are sellers offering size freely, or are they cautious, rationing and repricing quickly? Sixth, volatility behavior. Does volatility spike on down moves and compress on up moves, or the reverse? That tells you whether fear is being used to shake out weak hands, or whether buying is becoming more desperate. Now let's talk levels, because levels are where mechanics turn into decisions. I'm not going to throw a dozen lines on the screen and pretend that S analysis. In a market like this, levels matter because they change what other participants must do. A breakout zone, especially around major psychological numbers like $100, doesn't matter because it's magic. It matters because it changes hedging, positioning, and risk perception. Above a major number, call interest tends to grow. Dealers hedge differently and shorts feel more pain. Below a major number, late longs panic, liquidity shifts, and mean reversion traders get louder. So the key is not the number itself. The key is how price behaves around it. Does it hold and build, or does it break and accelerate? That's what tells you whether this is a retest scenario or a squeeze scenario. Here, it's a practical way to frame it without overpromising. If silver holds above the major breakout zone on any pullback, and the physical signal stays firm, premiums remain elevated, spreads remain supported, then the market is digesting strength, not rejecting it. That keeps the upside pressure alive, even if the tape is wild. If silver loses that zone decisively and physical premiums start to soften at the same time, that's when you treat it as a different regime, not bullish thesis dead, but tightness easing. And if you see a sharp pullback in spot while premiums stay stubbornly high, that's a classic split signal. Paper liquidation without physical relief. That can be the most emotionally difficult moment because it feels like you're wrong while the underlying tightness is still there. That's exactly when people get shaken out. That's exactly when the market uses volatility as a weapon. And that's where discipline becomes an edge. Now, we need to address the counterpoints because trust requires it. Could premiums rise for reasons that don't imply a broader silver squeeze? Yes. Fabrication bottlenecks can spike premiums even if wholesale supply is fine. A sudden surge in retail demand can overwhelm mints temporarily. Shipping disruptions can create localized scarcity. Policy headlines, tariff concerns, trade restrictions can cause preemptive hoarding or procurement acceleration. Financing shifts can make dealers less willing to carry inventory, raising premiums as a risk buffer. All of those can widen the physical paper gap without guaranteeing that spot must rocket higher tomorrow. And that's why the thesis isn't premiums up, therefore moon. The thesis is premiums up while spot lags as a stress signal in the settlement layer. And stress signals often resolve with price discovery catching up, unless the stress is relieved. That's the honest version. So you don't need blind faith, you need conditional thinking. If the stress persists, the clearing price usually adjusts. If the stress is relieved through supply response, demand cooling, or financing easing, the split closes the other way. And you can watch that in real time through the checklist. That's the whole point. You don't have to guess. You have to observe what the market is charging for: time, certainty, and deliverability. Let's pull this together into the two scenarios again, but tighter, because this is how you keep your head when the tape is trying to rip it off. Scenario 1, controlled pullback and retest. Silver pulls back under heavy volume, social media screams top, but premiums stay firm, spreads stay supported, and the market finds support near the breakout zone. That tells you the move is being digested by strong hands and physical tightness is not being relieved. In that scenario, the pullback is noise around a trend signal. Scenario 2, continuation squeeze and gap risk. Silver holds strong, liquidity thins, and a new burst higher. Forces hedging and short covering, possibly creating a gap move where you don't get clean entries. In that scenario, the risk isn't missing the move. The risk is getting chopped trying to chase it with no plan because volatility will punish impatience. Both scenarios demand the same discipline. Define what you're watching, define what would change your mind, and don't let emotion pick your timing for you. Here is the simplest invalidation lens that keeps you sane. If premiums and time pricing relax meaningfully and persistently, if the market stops charging for immediacy, that S the stress easing. That's the signal to reduce urgency in your thinking. If premiums stay elevated and time pricing stays tight even during spot pullbacks, that's the stress persisting. That's the signal that the split is real, not a retail mirage. And if you see the split intensify, premiums rising again while spot stalls, that's not proof of manipulation. That's the market telling you settlement risk is rising. And settlement risk is what forces price discovery. Because if this one level breaks, the math changes. Now, a quick word on the institutional psychology piece, because this is where a lot of people in the metals crowd get burned. Institutions don't need to believe in silver to create a move. They need to manage risk. When volatility spikes, they rebalance. When correlations shift, they hedge. When a trend emerges, trend followers follow. When a year starts hot, allocators chase performance. When month end approaches, reporting matters. That's not a moral judgment. It's a machine. And the machine interacts with a physical commodity that has real constraints. That's why silver can feel like it has two personalities. One day it trades like a high beta risk asset. The next day, it trades like a monetary protest. Both can be true, depending on which flows dominate that week. So if you want to trade this like a professional, you stop arguing about the one true narrative and start watching which mechanism is in control right now. And right now, the physical soster paper split is a mechanism story. It's a story about the cost of immediacy, the friction in arbitrage, and the segmentation between wholesale settlement and retail fabrication. It tells a story about how quickly demand can lock supply compared to how slowly supply can expand. Mining doesn't sprint, refining doesn't sprint, recycling doesn't sprint, logistics doesn't sprint. But demand can. Demand can spike in a week. That asymmetry is what creates premium spikes and curve stress. And when the asymmetry persists, paper eventually has to respect it. Not because of ideology, because of clearing, because of risk, because of margin, because of the reality that at the end of the chain, someone has to deliver something somewhere sometime. So here's your near-term roadmap, clean and usable. Watch the $100 zone as a behavior test, not a magical line. Do we hold above it on pullbacks, or do we lose it and accelerate lower? Watch premiums as the settlement stress gauge. Are they sticky, rising, or collapsing? Watch nearby time pricing. Is the market paying for immediacy or relaxing into carry? Watch signs of inventory mobilization into deliverable channels, not just totals in vaults. Watch ETF flow direction, especially around volatility. And watch the calendar, option expiry dynamics, month-end positioning, delivery window chatter, because that's when forced decisions hit. If strength holds through calendar pressure, that's telling. If it breaks and physical loosens, that's telling too. The market is talking either way. Your job is to listen, not to argue. And one more thing, because this is the part that keeps people solvent, even if the thesis is correct, price can whip around violently. The market can drop hard just to clear leverage, then rip again. It can spike, then dump, then spike. That doesn't make the underlying tightness fake. It makes the market a market. If you anchor your decisions to emotion, you'll be used as liquidity. If you anchor to mechanics, premiums, spreads, time pricing, behavior around key zones, you give yourself a psychological shield. You stop being the person who knew it but got shaken out. You become the person who watched the pressure points and acted with intention. If you've been around the metal space long enough, you know the crowd splits into two camps. The camp that stares only at the chart and mocks premiums as retail noise, and the camp that stares only at premiums and dismisses the futures market as fake. Right, both camps miss the actual edge. The edge is in the split itself. The edge is in understanding that the clearing layer and the settlement layer can diverge, and that divergence is information. It's not a religion, it's a signal. And right now, the signal is saying, physical is charging for certainty. And paper hasn't fully priced that stress yet. That doesn't guarantee a straight line higher. It suggests a setup where the next move is likely to be mechanical, not emotional. And that's exactly why it can be so violent when it comes. So here's the practical close. Targets are always conditional, but structure gives you reference points. If silver holds the breakout zone and the physical signal stays firm, the market remains biased toward continuation, with the risk of sudden upside gaps driven by forced hedging and short covering. If silver breaks down and physical premiums and time pricing relax together, that is the market telling you the stress is easing and the split is closing by physical loosening, not by spot catching up. Your invalidation level isn't BRT, just a price print. It's the combined failure of the physical signal and the time signal. And your next week checklist is simple. Premiums, nearby spreads, delivery tone, ETF flow, and behavior around the major zone. That's what you watch when headlines get loud. And if you're the kind of investor who wants logic over noise, who rather understand what participants are forced to do than chase whatever the crowd is yelling, then you're in the right place. Stay in the pocket with the mechanics, not the emotion. Because the market is about to test who's paying attention, and the people who survive are the ones who keep their plan when the candles get violent.